We expected positive returns for both bonds and equities, although our preference after adjusting for risk went to bonds. As of today, both bonds and equities were able to generate positive returns, but surprisingly, equities did much better and were better even in risk-adjusted terms. Also, we have observed quite divergent returns both across and within equity markets. But again, the biggest surprise was the good performance of the equity market and the lower than feared volatility. The different behavior of bonds and equities suggests that market participants have still different expectations about the way forward with monetary policy and economic risks. Equity markets are much more optimistic than bond markets, although corporate bonds have profited from the optimistic equity sentiment. This is a bit surprising because both the intentions of the central banks and economic risks are well known. Difficult to forecast, on the other side, was the boost that the recent developments in artificial intelligence gave to IT and IT-related stocks. While the technical achievements are quite exciting, the extreme positive reaction of the market reminds me of what happened around the year 2000 in the so-called dot-com bubble, when markets significantly overestimated the impact of internet on earnings in the short term, before a significant correction. I expect that we will see significant market jitters in the next few months. But overall, we don't think that we would need to revise our expectations. The very strong equity performance in the first half of the year, but also the very significant divergence between markets and sectors, is something that we are observing very closely, as we suspect that this will at some point be reverted. But we are also considering if our base scenario of a mild recession and its implication, for example, for earnings are still valid. So far, our conclusion is that while the global economy is more resilient than we were expecting, our base case is still valid. We are therefore still cautious in our positioning, although we would likely use a correction to increase our equity exposure.